안녕하십니까. 이베스트투자증권 글로벌 상품영업팀의 김성주입니다. 오늘은 일단 새로 오신 분을 모시고 2023년 경제전망에 대해서 한번 이야기해 보려고 합니다. 일단 세계 최대의 파생상품 거래소를 운영하고 있는 이제 CME그룹에서 수석 이코노미스트로 근무하고 계시는 에릭 놀란드 상무님을 모셨습니다. 간단하게 에릭 놀란드 상무님을 소개한다면 현재 경제분석 전문가로서 금융시장 트렌드 조사, 평가 및 분석과 경기 전망을 하고 있으며 세계경제 및 금융과 지정학적 여건과 관련해서 이제 CME그룹에서 대변인으로 활약하고 계십니다. Erik Norland, please say hello to the audience.
Yes, hello and 감사합니다 for allowing me to be here with you today.
네, 그리고 테이바랩의 강승희 대표님과 엑스컨트의 조세열 전무님도 같이 한번 모셨습니다. 네, 안녕하세요.
안녕하세요.
네, 그러면 이번 영상에서는 일단 에릭 놀란드 상무님은 이제 2023년 경기를 어떻게 전망하고 계시는지 들어보고 이제 강승희 대표님하고 조세열 전무님과 이제 궁금한 점을 차례로 좀 질문하는 시간을 가져보도록 하겠습니다. 네, 먼저 에릭 놀란드 상무님의 2023년 경기 전망에 관해서 이제 이야기를 한번 들어보도록 하겠습니다. Okay, let's start your speech.
All right, well, thank you so much for having me here. It's a pleasure to be here. In the last 3 years, since the last time I was able to come here to South Korea, a great deal has changed in the economy. The 20-teens, the decade from 2010 to 2019, was in some ways a very boring decade for the global macroeconomy. Almost every year, economies grew slowly but steadily, and inflation was almost always around 2% in all of the major economies. Unfortunately, the world is no longer boring today. We now have inflation rates of 6, 7, 8%, sometimes higher depending on the country. And we have very tight labor markets, and this has created tremendous challenges for investors. So during the next few minutes, I would like to sort of outline what some of these challenges are. Before that, I am required by CME Group to show you both the short version as well as the longer and more detailed version of our disclaimer, which essentially says that we are unable to offer you any investment advice. So no investment advice is given or intended. Now, with that in mind, I think the most basic question that any investor can ask is what is already reflected in the prices of the market. And so when you look at the Fed funds futures curve, it gives you a sort of central scenario that traders and investors at this particular moment in time believe is the most likely outcome for the Federal Reserve. And that forward curve suggests that the Federal Reserve is most likely to increase interest rates by 50 basis points on December 14th, and then probably to raise rates an additional 50 basis points at some point in the first quarter, most likely at their February meeting. And then the market thinks that the Fed will most likely go on hold and keep interest rates unchanged for a long period of time, for at least 6 months, until finally the Federal Reserve, in the view of traders, is likely to begin cutting interest rates late in 2023 and throughout 2024. Now, this is the market's most likely scenario at this particular moment in time. I would warn you, however, that market scenarios can change very, very quickly. When you look at the Fed funds futures historically, and in particular when you look at them at the end of 2021, at the end of 2021, the market was pricing that this year in 2022, the Fed might hike interest rates by 75 basis points. Well, here we are close to the end of 2022, and the Fed has already raised interest rates by 400 basis points and seems likely to do another 50 basis points later this year and another 50 basis points early next year, bringing the total to 500 basis points. Now, what the Federal Reserve has done this year is, I think, truly remarkable. It is the largest interest rate increase in a single year since 1979. And I think it is going to have very, very profound consequences for the economy. And I would suspect that the economy will slow down very quickly and perhaps have a recession sometime in late 2023 or 2024. which would oblige the Federal Reserve to potentially cut interest rates much more quickly than what the forward curve suggests. Now, the Federal Reserve's actions have had a tremendous impact on all sorts of different markets, including precious metals like gold and silver. One of the questions we hear frequently from investors is, why have the price of gold and silver not gone higher? Aren't those two metals supposed to be inflation hedges? And the truth is, I think that inflation has been pulling gold and silver prices higher. However, gold and silver prices both display a negative correlation with changes in the Fed funds rate. So the fact that the Federal Reserve has been tightening interest rates so much has been pulling gold and silver prices downwards. And I think that so far, the monetary tightening has been stronger at pulling gold and silver down than inflation has been at pulling them up. But that may be about to change, given that the market now expects that within the next 3 months, the Federal Reserve is likely to stop hiking rates and then potentially go on pause before eventually cutting rates. Now, the price of gold often goes in the opposite direction of expected interest rates. When investors expect the Federal Reserve to cut interest rates, as they did in 2019 and 2020, the price of gold often goes much higher. In that case, gold prices rose from $1,200 per ounce to over $2,000 per ounce. So when the Fed goes on pause and then potentially starts cutting interest rates sometime later in 2023, that could be potentially very good news for gold. Gold, after all, is a sort of currency, but it's a currency that doesn't pay any interest. So when interest rates rise on government-issued currencies like the dollar, typically that's not a good thing for gold. Now, the most remarkable feature of the economy in the last few years has been the sudden return of inflation. The United States and Europe are now suffering their highest inflation rates since the early 1980s, about a 41-year high in the pace of inflation. And one of the key questions that we have is whether inflation is going to last or not. And this is a complex question to answer. But in order to answer it, it's important to first understand why inflation has happened and why it has become so severe. Well, inflation happened, I think, to a large extent because governments overstimulated their economy during COVID. During the COVID lockdowns, governments issued tremendous amounts of aid to corporations, to small businesses, and to individuals and households to keep them solvent during the crisis. And while this aid, I think, in many respects helped to prevent people from falling into poverty and helped to prevent businesses from going bankrupt, it was also highly inflationary. And we see this here in the U.S. consumer spending numbers. Before the pandemic, consumer spending in the United States was growing at a nice, steady trend. Then it rocketed upwards to extremely high levels that outstripped the ability of the U.S. economy or any other economy to supply those goods. And you see the dramatic effect that this had with respect to the U.S. budget deficit. All of this government spending took the U.S. budget deficit to 20% of GDP, which was the highest level ever seen during peacetime, and only had been seen once before, and that was during the Second World War. The United States spent far more money than did most other countries when it came to COVID aid. For example, in the Eurozone, government spent only roughly half as much as the U.S. did. This is why we think the U.S. is experiencing mainly a demand shock, demand-driven inflation. Whereas inflation in other countries like Korea and Japan and Western European countries is being driven by a combination of some demand shock plus a supply shock coming from the high price of natural gas throughout Europe and Asia. But again, one of the key questions that any investor can ask is what is already reflected in market prices. And so when you look at what's reflected in market prices, it's very clear. In the United States, the U.S. Treasury issues two different kinds of bonds. It issues the standard U.S. Treasury bonds, and it also issues an inflation-linked bond called a Treasury Inflation Protected Security. And the difference in these two yields between the standard and the inflation-linked bond allow you to calculate the market's expectation for inflation going forward. And remarkably, the market expects that inflation is going to return to 2.5% almost immediately. Now, personally, I find this very hard to believe. It seems to me very likely that inflation will come in substantially higher next year than the market currently prices. So what are the upside risks to inflation? Well, first of all, one of the major upside risks to inflation is the fact that labor markets are very, very tight. The United States has unemployment at only 3.7%, which is close to its lowest level ever. And this means that it's very difficult for employers to find enough workers. In Europe, unemployment rates are even lower now than they were before the pandemic. In the United States, for example, we have employment now past its previous peak. And in 2019, the last time we had employment at similar levels, employers were looking to hire 6.5 million workers. Today, those employers are looking to hire 10.3 million workers. So essentially, they're trying to look for about 4 million more workers than they were seeking before the pandemic ended. Now, I'm sure many of you have seen in the news media that there are layoffs happening in the United States, particularly at large technology companies. And while this is true, the number of workers being laid off is still very small. Meanwhile, there's a tremendous deficit of workers throughout much of the service economy, at restaurants, at hotels, at airlines and airports, where the employers are desperately seeking people to work. And this is putting upward pressure on wages. Now, part of the problem in the US and other countries is that wages are growing very quickly at around 5% per year, whereas productivity is only growing at around 1%. And so all of this is contributing to upward pressure on inflation. Another major issue is the issue of housing. In the United States, housing accounts for 30% of the consumer price index. And the way in which the United States measures housing is very curious. It's measured only through rents. So it has nothing to do with the actual price of buying a home. But what is very interesting in the United States is that rental costs typically follow the cost of buying a home, but with a lag of 1.5 to 2 years. Now, the price of buying a home reached its fastest rate of increase this past May, when home prices were rising at 20% year on year. Since then, the buyer's market has cooled down. But the reason for this is that mortgage rates have more than doubled. Mortgage rates have risen from 3% to around 7%. And this is making it extremely expensive and, in fact, unaffordable for many people to buy houses. As a result, people who would like to buy houses are forced to remain in the rental market, which has an extremely low vacancy rate. So we're starting to see a lot of upward pressure on rental costs that are rising at 7% year on year. Now, if rental costs rise at 7% year on year, and they're 30% of the index, that implies that rental costs have added 2% to inflation before you even look at the other 70% of the index. And with the other 70% of the index, it's heavily influenced by wages, which are growing at close to 5% per year. As such, it seems quite possible that in 2023, we could see inflation somewhere between 4 and 5%. That's lower than it has been recently, but it's much higher than what the bond market expects. And so all of this has been very troubling news to equity and bond markets. Equity and bond markets had a sort of dream decade during the period from 2010 to 2019. During this period, stock prices went up, bond prices went up, and they had generally a negative correlation, which meant that institutional investors who were invested in both stocks and bonds achieved exceptionally high risk-adjusted returns. Now, however, bond prices have been falling and equity prices have been falling with a positive correlation. This has been making it very difficult for institutional investors who've been seeing large losses in their portfolio. Another risk associated with this is the fact that the Federal Reserve has begun a quantitative tightening program. We think that the U.S. equity market diverged from its fair value as a result of the Fed's quantitative easing program that they began in March 2020. Over the course of 2 years, the Federal Reserve printed $5 trillion, which they used to buy largely government bonds, with some mortgage bonds, and occasionally even corporate bonds. This depressed the level of bond yields and inflated the price of bonds and equities and other assets, including real estate. Now, however, because of the inflation, not only is the Fed raising interest rates very quickly, they are reducing the size of their balance sheet at a pace of $95 billion per month. And this could put a lot of downward pressure on asset prices, including real estate and stock prices. This is of particular concern because the stock market, as you can see in the right-hand chart, still has very, very high levels of valuation. The GDP, the equity market cap to GDP ratio is 140%. Now, that's off of its recent highs of 180%, but it's still very, very high. And as you can see, the market's valuation level tends to vary inversely with the level of long-term interest rates. When long-term interest rates are very low, the equity market can support very high levels of valuation. However, when the equity markets, when bond yields are very high like they were in the 1970s and 80s, equity valuations tend to be very, very low. And so the problem for the market now is that if inflation does not return to normal levels very soon, bond yields could potentially start rising again. And that could destabilize an equity market that has very high levels of valuation. One of CME's more recent products are annual dividend index futures, which allow you to look forward at a forward curve of dividends. The forward curve in dividends suggests that investors don't believe that there will be any growth in dividend payments or corporate profits over the course of the next decade in nominal terms or in current dollar terms. If you inflation adjust that, using the break-even inflation spreads from treasuries, investors actually believe that corporate profits and dividends will fall in real terms. Now, this I think is very interesting news for the stock market. If you take those dividend index futures and you sum them up, what you get here is the black line. And the S&P 500, the main sort of stock market index in the United States, is the blue line. Now, before the pandemic, the net present value of these expected future dividends moved almost perfectly in line with the stock market. So from 2016 until March 2020, the movements of the equity market were explained by investor expectations of dividends and by changes in interest rates that were used to discount those dividends back into present value. However, in March 2020, when the Fed began printing $5 trillion of assets, there was a divergence between the stock market price and the actual value of the market. And it seems to us possible that the S&P 500 is trading at about 1,000 or maybe even 12 or 1,300 points above fair value, meaning that the market may have to fall an additional 30 or 35% to get back to a more reasonable valuation level. Now, here I'm going to show you something that is not traditional economics at all, but it's something I've been observing for a long time in the markets that I think is very important. And it's something that has also recently caught the attention of the US Federal Reserve. Now, 5 years ago, I published a paper on the relationship between the yield curve, which you see here in the left-hand chart, and the level of market volatility, which you see in the right-hand chart. Now, the yield curve is the difference between long-term interest rates and short-term interest rates. So when we're up at the top of the graph, it means that short-term interest rates are low relative to long-term rates, meaning that monetary policy is very, very easy. When we're down at the bottom of the chart, as we are at the moment, that means that short-term and long-term rates are about the same level, which means that monetary policy is very, very tight. And right now we have a very tight monetary policy. Now, on the right-hand chart, we just have the S&P 500 implied volatility of options. Now, when you look at these two figures, there's no obvious relationship between them. However, in a moment we will see there's a very strong and very strange relationship. But to see it, you have to take a 2-year moving average of the yield curve and a 2-year moving average of volatility. When you do that, you get this kind of crazy looking chart that looks like maybe a 3-year-old's drawing with a crayon, or perhaps a piece of modern art. But what it does is it takes a relation between, on the one hand, on the vertical axis, monetary policy. So when we're at the top of the chart, monetary policy is easy. When we're at the bottom, monetary policy is tight. On the other axis, on the horizontal axis, when we're at the left-hand side, volatility is low, and we are at the right-hand side, volatility is high. Now, I know this chart makes no sense by itself, but let's break it now into 3 different parts. So if you focus on the left-hand chart, and you look at the numbers 1990 and 1991, in those 2 years, the United States had a very flat yield curve because we had very tight monetary policy, and markets were very volatile. The result of this was a deep economic recession in the early 1990s that coincided with bank failures and falling real estate prices. As a result, the Federal Reserve cut interest rates. As they cut interest rates, that steepened the yield curve. So by 1992 and 1993, we were moving up towards the top of the chart. As the Federal Reserve eased policy, they injected a great deal of money into the economy. This reduced the amount of volatility in the markets. So we moved to the left-hand part of the chart. And in 1994, the Federal Reserve decided with the economy recovering and markets calm, they could then begin raising interest rates. So they raised interest rates, moving us towards the bottom of the chart by 1996. Now, in 1997, these tighter interest rates began to create problems in the global economy. And those problems began right here in Asia. First in Thailand, where the currency collapsed, creating a crisis that quickly spread to other Asian nations, including South Korea. And by 1998, this had spread to Russia, which defaulted on its debt, which blew up an American hedge fund called Long-Term Capital Management. And by 2000 and 2001, on the right-hand chart, you can see we were right back to where we had been a decade earlier. Volatile markets and a flat yield curve. The result was a recession. The NASDAQ index fell 85%. Technology stocks collapsed. The technology companies began laying off workers in large numbers. The Federal Reserve responded to this once again by cutting interest rates. As they cut interest rates, they steepened the yield curve. This eventually reduced volatility in the markets. So by 2004, 5, and 6, the Federal Reserve was tightening policy. By 2007, we again had a flat yield curve, but very calm markets, at least for an initial moment. But then this triggered the global financial crisis. As a result of the Fed's tightening, real estate prices began collapsing and banks began to fail. So over the last decade, we've come full circle. The Federal Reserve in 2009 cut interest rates to 0. We steepened the yield curve, and over many years this time, it took 5 years to reduce the volatility from the global financial crisis. At the end of 2015, the Fed began raising rates, and they finished raising rates in 2018, and this had the predictable effect of increasing volatility in the market through 2019, and of course, in 2020, we saw a big rise in volatility with the pandemic. But then something weird happened. With the pandemic, the Fed cut rates to 0 and printed those $5 trillion worth of assets. As a result of this, the yield curve never really fully steepened. But now the Federal Reserve has raised interest rates to 5%. The yield curve is rapidly flattening. I think what is going to result here is very simple and very clear. The Federal Reserve is going to generate a downturn in the economy. They're going to generate an explosive rise in volatility in 2023 and 2024. This is going to put a lot of downward pressure on asset prices, including equity markets. And so I think we're in a very, very volatile period. This volatile period could be made worse by the fact that debt levels have soared all around the world. The Federal Reserve is raising interest rates at a time when the United States has very close to record levels of public and private debt. Europe and the United Kingdom are raising rates, as they also have very high levels of debt. And of course, debt levels in China, which were very low in 2008 and 2009, are now even higher than they are in the US and Europe. The Chinese debt market, I think, is in particular concern. A lot of China's debt is in the non-financial corporate sector, primarily in the real estate sector. And Chinese bond yields have been falling, or should I say Chinese bond prices rather, have been falling very quickly, which is putting upward pressure on China's bond yields and making it more and more difficult to finance China's debt. So all of the world is in the same boat. Interest rates are rising amid high debt levels, which could slow down economic growth. Now, China's economy has a very strong correlation to many commodity prices, including aluminum, copper, wheat, soybean oil, corn, crude oil, and silver. And so as China's economy slows down, it could potentially put a lot of downward pressure on commodity prices. Now, the key thing with commodity prices is that they often follow what's happening in China, but with a lag of anywhere from a year to a year and a half. So slower growth in China today could impact commodity prices even 1 or 1.5 years in the future. That's true for West Texas Intermediate crude oil. It's true for corn. It's true for wheat. It's true for soybean oil and many other commodities. Now, when it comes to agricultural commodities, the markets expect that corn and soybean prices will stay relatively unchanged for the next year, but then they will begin to fall in the second half of 2023. The one exception to this is wheat. The major exporter of wheat is Ukraine and Russia, and with the conflict between these two nations, traders think there is a strong possibility that wheat prices could remain high for a very long time. Now, we have also seen a tremendous rise in wheat implied volatility. The markets don't think that the corn and soybean markets are exceptionally risky, but they do think wheat prices are exceptionally risky. When it comes to oil prices, markets think that the most likely course for oil prices is downward. However, I would warn you that the markets also have a very high implied volatility on oil and oil product options. They see these options as having a 50% implied volatility, which is roughly twice as high as they were before the pandemic. And the skewness on those options prices faces upwards, which is to say the out-of-the-money call options are much more expensive than out-of-the-money put options. What this tells us is that traders think that, well, the most likely course is for prices to fall. If an extreme event happens, the extreme event is much more likely to be upward in price than downward in price. The reason why that's the case is because inventories are exceptionally low for ultra-low sulfur diesel and gasoline in the United States and many other countries. So low inventories leave the market with very little cushion in case there's some sort of a problem. I will leave you with just one last thing on oil prices, which is a strange relationship between oil, like West Texas Intermediate crude, and vegetable oils such as soybean oil. Very often I speak with farmers around the world, and one of the questions they often ask is, what does the crude oil market tell us about vegetable oils? And I often tell them that the question is better asked the other way around. It seems as though vegetable oils are sometimes a leading indicator of crude oil. For example, in 2006, crude oil prices fell a great deal at the end of the year, but vegetable oil prices were starting to soar. The result was that crude oil followed vegetable oil prices higher. Now, vegetable oil prices peaked in January 2008. Crude oil prices didn't peak until July 2008, 6 months later. Now, vegetable oil prices fell before crude oil, and they hit bottom in December 2008, 2 months before crude oil prices hit bottom in February 2009. Vegetable oil prices like soybean oil peaked out before crude oil in 2011 and began a long slide that anticipated a collapse of crude oil prices at the end of 2014. Vegetable oil prices like soybean oil hit bottom in October 2015 before crude oil did in February 2016. Since then, many of the little peaks and little valleys in vegetable oil prices have been followed by peaks and valleys in crude oil prices, including the most recent ones. For example, vegetable oil prices peaked in May 2020, crude oil not until the end of June 2022. About a month and a half later, after, I should say, the peak in soybean oil was in May 2022, not May 2020, and crude oil peaked out a couple of months beyond that. So the question is why? And I think that there's two reasons. First, 65 countries around the world, including the United States, the countries of the European Union, China, and Indonesia, as well as Brazil, have some sort of biofuel mandate that requires that some sort of vegetable matter, whether it's ethanol from corn or soybean oil or palm oil, is mixed into the fuel blends. In addition to that, the vegetable oil market, even though it's very liquid and tradable, is very small compared to crude oil. As such, when the refiners ask for more vegetable oil, the vegetable oil markets, which are relatively small, can be hypersensitive and respond in advance to coming changes in crude oil prices. Now, recently, I would point out that vegetable oil prices have been rising again in recent months as crude oil prices have been falling. This may be an indicator that the crude oil market and refiners are anticipating a rally in crude oil that could happen later on, perhaps as a result of China changing its COVID policies or other impacts to the market.
네, 지금까지 2023년 이제 전망, 이제 경기 전망을 시작해서 이제 경기 전망과 함께 귀금속을 비롯한 이제 원자재와 이제 연관되면서 이제 설명을 해주셨습니다. 금리 인상은 언제까지냐, 언제까지 이제 유지가 되고 또 언제 인하를 할 거냐가 가장 궁금해하실 텐데, 에릭 노랜드 사무님께서는 일단 2022년 12월에 50bp, 23년에 2월에 다시 50bp 인상 후 한 6개월 동안은 이제 금리 인상 인하 없이 유지가 되면서 2023년 말에서 24년 초에는 인하를 시작할 거다라고 이제 전망해 주셨으면서 인플레이션은 2.5%까지 이제 추후에 낮아질 거라고 전망을 해 주셨습니다. 그러면서 뭐 귀금속 같은 상품, 이제 뭐 농산물, 에너지와 같은 이제 크루드 오일과 모든 상품에 대해서도 이제 전망을 해 주셨고, 강승희 대표님하고 조세열 전무님의 이제 조금 전망에 대해서 좀 질문을 한번 좀 해보는 시간을 갖도록 하겠습니다. 먼저 일단 에릭 노랜드 상무님께서 펀더멘털, 좀 이코노미 쪽을 먼저 얘기를 해주셨기 때문에 강승희 대표님께서 먼저 질문을 한번 좀 해주셨으면 합니다.
Okay. Thanks for your sharing your opinion. I think you mentioned about the Fed fund futures is implied the consensus of the market, and then that means that is just an expectation. Normally, do you have any opinion about in the past? Is the Fed fund futures what is exactly right at the futures? I mean, it's the implied rate is just implied, right? It's the next 2 years. It's the implied rate is not the right.
That's right. Yeah, the Fed funds futures can be very, very wrong in its expectations for what's going to happen. Now, I wrote a paper on this a few months ago in February, where I looked at what the Fed funds futures were pricing before each of the last 4 rate hike cycles, 1 month before they began. And on average, they underestimated the amount of rate hikes by anywhere from 175 basis points to 300 basis points. Well, so far, they've underestimated the amount of rate hikes by at least that much this time again. I would also warn you that the same is true the other way. Yeah, when the Fed funds futures start thinking that maybe the Fed's going to cut rates in the future, they often underestimate how much the Fed will cut rates. For example, in 2007, at the beginning of the global financial crisis, the Fed had rates at 5 3/4. At that time, the Fed funds future was thinking maybe they would cut rates 75 basis points. They cut rates all the way to 0. Yeah, so there can be really big differences between what markets expect and what actually happens.
Yeah, so you expect the 50 pips 50 basis point increase in December, and the next year is a 50, and then later then is cut down again, right? But it's at the moment is your expectation and almost same as the Fed fund probability, or just your opinion is different?
Okay, so I think in the short term, I pretty much agree with the Fed funds futures. I think it's very likely that they hike 50 basis points on December 14th. As we get into early next year, I think it gets a little bit more difficult, but I still more or less agree they hike probably another 50 or so in the first quarter. It depends what happens with economic data, et cetera.
Yeah.
But then, given the level of debt in the economy, I think the economy could slow down very, very quickly, much more quickly than the Fed thinks. And so when I look at this Fed forward curve, I think it could be a lot worse in terms of rate cuts than what the market thinks. And the market thinks the Fed will cut rates from 5% to maybe 3 3/4.
Yeah, yeah.
I would imagine that they could very easily go further to 2% or 1%.
That means inflation is gone, right?
Well, not necessarily. So this is the trick. I think inflation next year is going to run quite high because inflation is a sort of lagging indicator. It tends to follow what's happened in the economy already. And so it can take a long time for inflation to come down. But the Fed, I think, is facing a really tough situation where asset prices are very high, debt levels are very high, and inflation is high. And now they've raised interest rates. So what I think happens next is that the economy begins to start doing quite badly, perhaps in the second half next year. And as a result, the Fed may have to face a choice where they have to choose between fighting inflation and financial stability. And I think they will choose financial stability. And this, by the way, is the same choice that the Bank of England had to make 2 months ago. Yeah, when the UK Treasury market, called the gilt market, had a severe sell-off. The Bank of England had been intending to tighten policy, but it actually found itself printing money to save the bond market. So I think the Fed will have a sort of similar dilemma that it faces next year.
What is already the Yellen speak to about the buyback program from the Treasury, not Fed? That is for that reason, right?
Yes, that's right. So if the Federal Reserve won't step in and do it, then the U.S. Treasury has some capacity to do it, but maybe not as much as the Fed, because the Federal Reserve can, as we've seen, create an infinite amount of money, which the Treasury can't do.
Yeah, but that is the opposite side of the QT. So but this one is just a liquidity providing to the market. It's not the real buy, right?
Yes, exactly. So the Federal Reserve can provide just liquidity to the market, which they did, for example, at the end of 2018. In 2018, they were doing a quantitative tightening like they're doing now. And at the end of that year, we ran into a repo problem in the Treasury market. And the Fed did a temporary sort of miniature QE that lasted only a few months, just enough to solve the problem.
Yeah, that means the Federal Reserve don't want to rates hike very high, right?
Well, the Federal Reserve has already hiked rates very high.
Very high?
Yeah, what I think what the Federal Reserve doesn't want is the Federal Reserve just wants inflation to go away and they want the economy to go back to normal. But what they don't want is they don't want financial instability and they don't want high inflation. But the problem is in fighting inflation, they might bring about financial instability, which forces them to make a choice.
Yeah, they can do the financial stability, but inflation is not, they cannot control the inflation because the China market, China and US has some trouble still.
Yes.
And even after the Trump government, the labor market also very tight.
Yes, that's right.
So that means it's very difficult to handle the inflation by the Fed.
That's right. Yeah. They're in a difficult position. I mean, the Fed, in a sense, has handled worse inflation problems before, like the one in the late 70s and early 80s, but they handled it by putting interest rates at very high levels and putting the economy into a very, very deep recession until unemployment rates rose, which reduced the pressure on the labor market. And the question is, do they have the political will to do that this time?
Yeah, I think so. So another one is for the recession, is that you expect the U.S. equity market is very overvalued, right?
Yes, my view of it is it is very substantially overvalued.
Yeah, but that means is the U.S. has getting the recession quite hard, right? Hard recession, not soft landing.
It's possible that the United States could have a recession next year. The Federal Reserve would obviously prefer a soft landing.
Yeah.
But the thing is, they've hiked rates so far in 2022 more than in any year since 1979. And after the 1979 rate hikes, the U.S. economy had a very, very severe double dip recession in 1980 and then again in 81 and 82, which eventually did reduce inflation, but it was a very, very painful process.
Okay, and but currently is the labor market is still hot, as you mentioned.
Yeah.
So is IT and the Apple and Amazon and big IT company is start to the fire recently, but they are the very high cost, high wage people.
Right, they are,
and,
yeah.
So it's just blue collar labor market is still hot. That means is the labor market is still good compared to before.
That's right, yeah. So for many professions, for electricians, plumbers, carpenters, service workers, people in people working for hotels and restaurants, the labor market is very tight. It's just red hot.
It means is that they are very strong. Means is the high wage people have to spend money more because
that's right.
Yeah. So that means is the consumption is good for the futures. It means is equity and corporate earning is not that bad as we expected. That means is the equity market is already around 30% drop. Most of the small stock is 50 to 60%.
Yeah.
So it means price-wise, I mean, fundamentally it's very high value, but it's already expend the money for the 5 years already. So it's the money is inflow is already there, but it's the Fed cannot take out the money from the economy. It means its equity price is already implied or not. It's a little bit very difficult to say.
Yeah, it is, and I think it really depends on the sector of the equity market. As you rightly point out, there are certain sectors of the equity market that are a bargain. Small cap stocks have not really participated so much in the rally. So smaller stocks like you see in the Russell 2000 are relatively inexpensive. And in fact, most stocks in the United States are inexpensive outside of a few technology companies. But those few technology companies have a huge weighting in the S&P 500 and an even bigger weighting in the NASDAQ 100. So those two particular indices could be especially vulnerable to further declines.
Yeah, it means it's a passive, its inflow is poor, and then you're right. But it's a passive flow is still there. That means is that the big tech stock is can support, right?
That's right.
Yeah, so it's a very difficulty expect at the moment. So and another one is I saw the Nasdaq option volatility, implied volatility is lower than realized volatility in this year. Do you have any idea about the reason?
Well, I think that it kind of goes back to that crazy volatility chart that I showed. The Federal Reserve created $5 trillion of assets, and they had also put rates at zero. So they injected huge amounts of money into the financial markets. Now, when the central bank injects a lot of money into financial markets, what it does is it makes it very easy for buyers to find sellers and sellers to find buyers. So it tends to depress the level of volatility, including implied volatility. The problem now is that the Federal Reserve is taking that money back out through interest rate increases, an inverted yield curve, and quantitative tightening. So I think there's a risk that in the future we're going to see an explosion of volatility that may go far beyond what options traders in the NASDAQ or the S&P 500 expect.
So, but that is right, and then its implied volatility is move higher, but right now it's very low compared to realized volatility.
Yeah.
So I expect that its option buyer is gone because its implied volatility is very low compared to the realized volatility. Means its option buyer can make money for the volatility trading.
That's right.
Right.
Yeah.
But it's in 6 months, its realized volatility is very high compared to the implied volatility. So that's why I think this little bit of the option market player is very smaller than before, or the option market maker is gone, or
Yeah.
I'm not sure.
Yeah, something is going on. I mean, I think it's hard to imagine that there are no buyers because there has to be a buyer for every seller.
Yeah.
So the numbers have to equal, otherwise there's no
that's
trade.
Right, that's right.
Yeah, but I do think that maybe what's happening is that option prices tend to go higher when there's a strong directional move. And in the last, since June, the equity market hasn't moved so far. You know, the first half of the year was quite bad for stocks. But then since the 30th of June, stocks rallied in July and early August. Then they sold off again, then they rallied again. So the market's kind of been zigzagging. So without a strong direction, that might be what's preventing options prices from rising. But that could be temporary.
Temporary. And the additional one is weekly option is very, very popular in US. So I saw the news is 44% of the option volume is the 2-day option.
Yeah.
Right. So is that is the impact too much or not? Is I'm not sure. Is what your opinion?
You know, I don't really have any opinion of it. All I can say is that I'm an economist, so I tend to think in terms of 6 months, 1 year, 2 years.
That's
I
right,
can't think in terms of 2
In
days, so
terms of
I could
short-term
never
options.
trade that. I don't know.
So I think that makes a big the impact for the stock market. I mean index market, because short-term option makes a lot of noise into the market. As you mentioned, it's the economy is very stable. I mean not stable. It's not volatile compared to the 2 days.
Yeah, that's right. Yeah, I look long term. So anything short term trading is a total mystery to me. Yeah.
Okay.
네, 감사합니다. 네, 다음으로 이제 조세열 전무님께서 이제 내년에 이제 원자재 전망과 관련해서 이제 좀 질문 사항이 있으시면 좀 해주시기 바랍니다.
Okay, thank you for sharing your opinions with us. And I have some question about the gold. So you mentioned that the high kind of Fed rate will prevent the gold rallying. But when you look at the gold price for over the 3 years, but the gold price was not that bullish when the interest rate is low and the inflation is high. So so what will be the condition for the gold rallying?
Yeah, so I think what matters for gold prices is not the level of interest rates, whether they're low or high. What matters is the direction of expected change in the future. So if the market is moving from expecting high interest rates to expecting low interest rates, which was the case in 2019 and early 2020, the price of gold goes much higher.
Yeah.
So in that case, as expectations for future rates came down from 3% to 0, gold went from $1,200 to $2,000 an ounce. But since then, there's been this kind of tug of war. So on the one hand, we have a lot of inflation, so the dollar is losing its value. So in theory, that should be good for gold prices.
Yeah.
But at the same time, because of that same inflation, the market's gone from expecting the Fed to stay at 0 to now expecting the Fed to get to 5% rates by the first quarter next year.
Yeah.
And that's been really rough on gold prices. But the good piece of news, I think, for gold is that there's expectations now maybe cresting. We may have gotten to the high point of expectations. Now, of course, that depends on whether the economy keeps growing, what happens to the stock market, what happens to inflation numbers. But if the Fed I think is likely the case.
Yeah.
I think what's going to happen, I think what's likely to happen is that the U.S. economy is going to go into a recession.
Yeah.
The Fed's going to be facing some sort of financial disturbance, a stock market sell-off or something like that, higher default rates. The Fed's going to have to cut rates quickly.
Yeah.
It's going to have to choose between inflation and financial stability.
Yeah.
It will choose financial stability and cut rates. And the price of gold could potentially soar to levels we've never seen
Wow.
before.
That's,
That would be my guess.
yeah,
It's only a guess, but
but very good kind of guess
yeah.
for the gold market. Yeah.
It's quite reasonable.
Yeah,
Yeah,
yeah. I think gold. I think gold. If the Fed begins to cut rates, as I think it may, that would be very positively seen by gold traders.
Okay. So maybe it's good time to consider kind of gold as a kind of a,
Yeah, I mean, sometimes the most money is made in the areas that nobody's paying attention to. And I think investors have forgotten about gold because it hasn't gone anywhere.
yeah. Very boring asset. Yeah.
For the last 2.5 years, it's done nothing. But sometimes it's the areas nobody's looking at that have the best opportunities.
Okay, so also the one more question about the gold. So for some period of time, so Bitcoin was regarded as a substitute of gold, and there are many scandals in crypto industry at the moment. So do you think gold can attract the attention from the kind of Bitcoin or crypto kind of currency?
It may. It's a little hard to say. I mean, when you add up the value of all the world's gold, held by central banks and by private individuals or corporations, it comes to around $7 trillion.
Okay.
That's far larger than Bitcoin or any of the other currencies ever got to in terms of market cap. But it is true, though, if investors lose interest in crypto, they might regain interest in precious metals like gold and silver.
Yeah. Okay, so nowadays kind of gold is quite undervalued at the moment, and because nobody is interested in at the moment. But I think it can be the good chance.
It could be,
Yeah.
yeah. I mean, it's no guarantee,
Yeah,
but
yeah.
it could be.
Yeah, definitely. Yeah.
No one guarantees.
Yeah,
Don't
no
worry about
guarantee. You don't have to guarantee. Yeah.
The one more question is that what do you think about the China economy and China equity market? Recently, it's a very big, the volume and very big volatile at the moment.
Yeah, so I would separate China's economy and China's financial markets. China's stock market is a very interesting thing. It reached its peak, I think, in 2007 or 2006. And it's spent the entire last 15 years basically trading in a range, even as US stock prices headed much, much higher. So I think that China's equity market is not particularly highly valued. It's not overvalued in the same way that the US stock market is. That said, I am worried about certain aspects of the Chinese economy. They have very high levels of debt and over-reliance on property. They're very dependent on manufacturing exports to the rest of the world. As the world reopens, consumers may not want so many manufactured goods. They may want to spend more money on experiences like travel and restaurant meals and movies. So I think there's a lot of reason to be concerned about China's economy, but that doesn't necessarily make the Chinese stock market a bad investment.
Okay, so I have a question about the crude market. So actually, you mentioned that the supply side is quite bullish after the OPEC Plus cutting, and also ultra low inventories. And recently, the China kind of stock market was jumped after the kind of COVID easing, but the people expect kind of a recovery of China at the moment, but when you look at the kind of the crude market is keep going down because China is a big consumer of the crude market, so the market should react bullish on the crude. So why this kind of things happen?
Well, I think that the near-term price of crude oil, so for contracts, say, expiring in January, February, March, those prices could still be under a lot of downward pressure because demand may remain weak from China and from other countries. Now, that said, if China does lift its COVID policies, they may not lift quickly enough. They may for the very near-term contracts. But it could, however, be very bullish for contracts expiring in June or December or further, December 2023, I should say, or further down the curve. I think once China reopens, as we've seen with the rest of the world, there's a real hunger for travel. And that could stimulate a lot of demand. On the other hand, China is not the only thing that happens in the world. And we have soaring interest rates, which is slowing economic activity in other parts of the world. So it's possible that higher interest rates, if they depress economic activity in the US and Europe and Korea and other countries, that could soften demand.
And also there are kind of Russian cap prices introduced in the market. So I think it should be the bullish point for the crude market, but actually it's not. So do you think the Russian cap is a kind of can be the bullish kind of?
Yeah, for me that's one of the greatest mysteries. I just don't know what its impact is going to be. I don't know if other countries are really going to adhere to it. I don't know. I just don't know what the impact will be.
Okay, so in the presentation you mentioned that S&P 500 is still kind of 30 to 35% overvalued even after the big falling this year. So do you think the S&P 500 need to go down additional 30% to see the bottom? Or?
Well, it's entirely possible. I mean, I'm not saying it will happen. Anything can happen. The stock market could go up. I think the positive scenario for the S&P is that inflation goes back down, bond yields go back down, and the economy grows more quickly than people expect. If that happens, the S&P 500 could be just fine. However, I do think it's very possible it could go down 30 or 35% more. And there's a lot of precedent for this. For example, in 1973, when we had a big inflation shock to the economy, prices in the S&P fell very sharply, and they continued to go down a second year in a row in 1974. Same thing in 2001. In 2001, the stock market fell really sharply, and it continued to drop in 2002. The bear market from October 2009 to March, or say October 2007 to March 2009 lasted a year and a half. There's a lot of precedent for bear markets to last more than 1 year. And this could be one of those cases in which the stock market goes down two years in a row.
And one last question. So you mentioned that the corn price follow the Chinese economic growth with the 1 or 2 years lag. So do you think the corn price can go down to the $3 level from the current $6 level within 1 or 2 years?
I think in order for corn prices to fall that far, it would probably be necessary to see a big decline in crude oil prices. If you make a graph of corn, or for that matter wheat prices, and you overlay them with crude oil prices, they tend to do more or less the same thing. So in order for that to happen, I think we would have to see a really sharp slowdown in Chinese economic growth, which would put downward pressure on crude oil prices, which in turn would put downward pressure on the prices of biofuels, including ethanol, which is derived from corn.
Thank you for the answer.
Okay, thank you so much for having me.
네, 이렇게 이제 에릭 놀란드님의 2023년 전망까지 해주셨고, 거기에 이제 강승희 대표님과 조세열 전무님께서 이제 각 분야에 맞춰서 이제 궁금하신 점까지 이제 다 질문해서 이제 답변을 드린 것 같습니다. 네, 일단 오늘 이제 참여해 주셔서 감사하고요. Thank you for your time to have the film the YouTube. 근데 마지막으로 이제 저희도 이제 2023년도에 이제 경제 전망을 하기 위해서 이렇게 귀한 손님들 모시고 이제 영상을 찍게 돼서 굉장히 영광을 생각하고요. 다음번에도 이렇게 좋은 기회가 있으면 또다시 이제 찾아뵙도록 하겠습니다. 다시 한번 귀한 시간 내주셔서 감사합니다. 네, 감사합니다. Thank you.
Thank you.